Good morning, Liz. Today we will be talking to you about provisions and contingent liabilities, presented to you by Athi, Rushi, Maitre, Sahil, and me. Provisions and contingent liabilities are a type of liability. So, what is a liability? A liability is defined as a present obligation of an entity that has arisen from past transactions, which will also result in an outflow of economic benefits. So, a liability is three main things. Number one, expected future sacrifice of assets or services. Number two, constitutes a present obligation. And three, and is the result of a past transaction or event. Furthermore, the degree of certainty will reflect how a financial liability is classified. For example, if it is completely certain as a financial liability such as accounts payable, it is recorded. If it is probable, like in warranty, it is also recorded. And C, if it's not probable, like a lawsuit that has a 10% chance of winning, it is just disclosed. Section IAS 37 explains how we account for provisions. A provision is defined as the future liability of an uncertain timing or amount. They are caused by both legal and constructive obligations. Now, to recognize a provision, three main things need to occur. It needs to be probable, that means the probability is higher than 50%. It needs to be measurable, and the definition of a liability is met. As well, it should be disclosed in the notes. In accounting for provisions, the best estimate of funds required to settle the obligation by the reporting date is recording on the balance sheet. First, the rule is we record the best estimate as the most likely outcome that should be considered. However, expected value is used if all points in the range are equally likely. Thus, the midpoint of the range would be recognized. So expected value is best for large population of items, as well for small population, the most likely outcome is most likely the way to go, as well as considering expected value and cumulative probabilities. When recording a provision, it's recorded under the current liabilities section on the balance sheet, and as well as an expense on the income statement. It's reviewed at the year end to best reflect estimate and subject to changes, and as well provisions can be reversed. There's certain keys in measuring provisions, so you want to make sure the best estimate includes all risks and uncertainties associated with that liability, including all future events. The provision should be discounted to present value using rates that reflect the liability in order to give it the best measurement. Provisions for one-time events usually take the most likely amount, or as contrast to things that repeatedly occur as warranties, which are usually measured at expected value. Provisions cannot be made for future operating losses, but however can be settled for owner's contracts. Now here's some example of provision. Lawsuits. A lawsuit is when one party sues another party, which can be settled in or outside of the court, and is usually assessed by a legal team. If it is measurable and probable, it would be a provision, so it would be recorded. Otherwise, it is a contingent liability and is disclosed in the notes. Executory contracts are liabilities that arise when performance takes place in the future. It is not a provision till the transaction takes place. An owner's contracts is when the overall costs of the contract exceed the benefits, in which a provision is set up in the amount of a loss. A restructuring is a plan that will change the scope of the business and is under control of management. This is also recorded as a provision, and all details must be disclosed. A warranty liability is more of a regular liability, and this is usually recorded on expected value and has to be adjusted on year end. On the other hand, a contingent liability is an event that is not probable, and it can't even be measured reliably. It wouldn't be recognized on the financial statements, it would just be disclosed in the notes. If it is not probable and not measurable, then it's a remote contingent liability which isn't even recognized or disclosed. There's no impact on the financials, there's just disclosure in notes. Moreover, a contingent asset has the potential to provide future benefit to the company. However, it is out of the control of the management. Thus, the asset's likelihood has to be virtually certain. It has to be over 95% in order to be recorded, and it has to be disclosed in the notes. It raises the assets on the balance sheet and a contingent gain on the statement of comprehensive income. Disclosures is necessary to make sure that this contingent asset is not a result of income from operations. For IAS 37, extensive disclosure about provisions are required to improve transparency in an area that's completely dominated by judgment. For example, number one, the provisions must be shown in a different category than other trades payable in order not to confuse people who are looking at the statements. As well, companies must disclose a reconciliation or a contingency schedule in each class of provisions. This includes the beginning and ending carrying amounts, the change to the provisions such as increases or decreases, usage or reversals, and amendments to the discount rates or changes to the amount during the time period. As well, you have to disclose each class of provision and any assumptions or any timing of future events used to measure that provision. That is extensive disclosure. As for contingent liabilities, each class of the contingent liability needs to be disclosed, as well as a brief description of what's going on with that contingent liability since it's not recorded on the balance sheet. As well, you would have to disclose the effect on the balance sheet or income statements in due to if that contingent liability does become probable. For the standard for private enterprises, ASPE, under Section 3290, tells us how to account for liabilities. The definition of a liability is a bit more relaxed. A liability under ASPE is likely a future sacrifice of assets or services, and it has to be measurable. Future operating losses like IFRS are not recognized, and it also tells us how to treat contingent losses or gains. Section 3290 defines a contingency as an existing condition or a situation involving uncertainty as to possible gain or loss to an enterprise that will ultimately be resolved when one or more future events occur or fail to occur. On the flip side, a contingent gain is never recorded under ASPE. They are not recognized until they are realized. As there are no provisions under ASPE, contingent liabilities are recorded using the best estimate. As well, if everything in the range is equally likely, we use the lower point of that range, which is different according to IFRS. A contingent liability can be recognized on the balance sheet, or it can be just disclosed in the notes. You have to recognize if there's likely an outflow of resources to settle that obligation. Now, contingent liability disclosure under ASPE is straightforward. If an obligation exists but it isn't recognized, it should be disclosed in the notes. As well, and for contingent liability, description of the nature of the obligation must be put down in the notes. The estimate or amount of the obligation, or if an amount can be estimated, that should also be put down in the notes. As well, any disclosure about future events that might affect the contingent liability, and any more exposure for loss on top of what's already accrued, if it was recorded. The differences in these two standards are quite simple. There's a difference in the word of contingency. In ASPE, a contingency is either recorded or disclosed, and it results in an outflow of resources only if another event happens. As well, under IFRS, a contingency is only disclosed. It is not recorded. It's also recorded and disclosed is a provision. Under ASPE, there's no guidance on owners' contracts or loyalty points. ASPE records equitable liabilities, but however, they do not record constructive liabilities. ASPE says asset retirement obligations as opposed to the decommissioning liabilities under IFRS. The effective interest rate method isn't required under ASPE, but however, it is needed for IFRS. A contingent gain is never recorded under ASPE as it is for IFRS if it's 95% certain. A lot less note disclosure is required under ASPE than IFRS, and you can use there's an expected value for IFRS versus the lower end of the range if all points are equal. So these are different ways that contingent liabilities can be accounted for differently under IFRS or ASPE.
So the first public company that we decided to focus on was TELUS. When we look at the financial statement representation, provisions show up both in current liabilities and non-current liabilities. As you can see from this slide, TELUS explains the difference between 2015 and 2016 provisions, as well as it gives an explanation on why these provisions changed. More information can be found in the note disclosure. Note 25 is dedicated to provisions where there are three major categories: asset retirement of property, plant, and equipment. The second category is employee-related due to the restructuring activities that TELUS took on in 2016. And lastly, in the other provisions categories, there's more information on written put options, contract termination costs, and onerous contracts. Note 29 is dedicated to the contingent liabilities, where TELUS gives information on the types and the reasonings for each liability. There are four major categories: claims and lawsuits, indemnification obligations, concentration of labor, and commitments for their contractual obligations.
In regards to Canadian Tire, they have three major sections of provisions. The first being sales and warranties, and now they do the accounting for sales and warranties based on a cost deferral basis. The other provision they have is called site restoration and decommissioning obligations. These ones are valued at expected value approach and are discounted as the years go by. Finally, they have a customer loyalty program that's quite extensive in their daily operations, and this is measured at fair value. It's expense as incurred and SG&A on the income statement, and that's how they account for it, and they discount all of these on a yearly basis. The remaining provisions are grouped in an account called Other Provisions. This includes inventory valuations due to shrinkage, termination benefits. Now, these are considered termination benefits if they have a plan and they're committed to terminating the employee without any withdrawal, or it can be done to encourage voluntary redundancies. In addition, they have onerous contracts, which is recognized when the expected benefits are lower than the unavoidable cost of meeting its contractual obligations. These are measured at present value of the lower of the expected cost of terminating the contract or expected value of continuing the contract. Canadian Tire has four major guarantees and commitments. The first one is that they have standby letters of credit. This is for their franchise trust, which is a third-party dealer that creates loans to dealers for inventory and fixed assets amounting to over $40 million. Second, they have a lease guarantee on franchise stores if unable to make lease payments for about $4 million. They have a third-party financial guarantees for third-party dealers who may default on payments, the majority of which have an expiration for July of 2017. Finally, they have capital commitments for acquisition of PP&E, investment properties, and intangible assets for over $54 million.
Thank you. And when looking at the financial statement presentation of Suncor, we can observe that provisions are divided into current and long-term liabilities. Its current and long-term liabilities are measured at amortized costs using the effective interest method. When delving into its note disclosure, Note 25 on page 114 and Note 31 on page 126 are disclosure of provisions and disclosure of commitments, contingencies, and guarantees. When looking at Note 25, provisions are divided into three separate components: decommissioning and restoration, royalty fees, and other, which consists of legal, environmental, and lease inducement provisions. In its calculation of its provisions, it starts with the current balance and its liabilities incurred during the year, then the effect of the change of interest rates, re-estimation provisions, and the settlement of provisions. Lastly, the accretion of the present value of obligations, asset disposals, and acquisitions, and the effect of foreign exchange are also included in the calculations of its provisions. Now moving on to Note 31, commitments include the use of operating leases that will remain significant until 2042 and other obligations for goods and services. Legal and environmental liabilities and operational risk are listed as contingent liabilities. However, they do not have a material impact on the statement of financial position, but is deemed necessary for disclosure. And lastly, its guarantees include loans to retail licenses and wholesale marketers, a guaranteed share interest in joint ventures, and to indemnify holders of notes and debentures and the company's credit lenders for added costs relating to withholding taxes.
So the last company we decided to focus on is HBC. They too break provisions down into both current and non-current and show values for 2015 and 2016 for a total of $226 million in provisions in 2016. HBC has provisions for self-insurance costs, onerous leases and contracts, decommissioning obligations, and other provisions regarding legal and restructuring. So the lease guarantee note represents the company's expected share of costs associated with a default on subleases guaranteed by the company, and the restructuring note includes preliminary costs associated with programs that increase operational efficiencies in HBC Europe and other restructuring costs in HBC North America. Additionally, HBC has note disclosure regarding contingent liabilities and three different types of guarantees. These include a standby letter of credit, lease agreements, and other indemnification agreements. In terms of the similarities and differences between the four companies, each firm has commitments, owners' contracts are included in the provisions, the most common method is used, that is amortized cost, and guarantees and commitments are not included in the balance sheet, rather just in the note disclosure. However, in terms of differences, Suncor, HBC, and TELUS have current and non-current portions of their provisions. TELUS does not have any guarantees, they only have commitments, and Canadian Tire actually has a major loyalty program requiring them to have a provision.
For the income statements, under ASPE, there's no other comprehensive income. Since on the balance sheet we took the lower value of the range, this will also correspondingly reflect on the income statements. So we have decreased expenses due to the lower estimate of the range being used, and a lower depreciation and amortization expense as we're using straight line rather than declining balance. As well, there's no specific standard regarding restructuring under ASPE, so we just copy what we did in IFRS. And this, you can see the restated income statements. There are lower values for all the provisions and contingent liabilities we set up.
In ASPE, the lower value of the range of an estimate is taken for a provision. This results in a lower value for provisions, both current and non-current. As you can see in IFRS, in 2016, the value is 124, but if ASPE is used in 2016, the value would go down to about 110 million. It reduces the value of total liabilities as well if no other accounts experience any change. And as always, guarantees and commitments are not included in the balance sheet.
The third statement that we've restated is the cash flow statement. Under ASPE, there are three major changes that would occur. Firstly, the net income and depreciation and amortization would change based on the income statement that was restated above. Lastly, the net change in non-cash operating activities would change. Because the provision balance in the balance sheet has changed, that same change would be reflected in the cash flow statement. Overall, cash flow would increase in the years 2016 and 2015.
Lastly, when looking at the impact of ASPE on the statement of retained earnings, the impact of net income changed as a result of decreased expenses and depreciation, which continues to affect the net income and thus improves the overall effect of retained earnings compared to IFRS. With its note disclosure, compliance of using the best estimate based on an equal point system is disclosed. Contingent liabilities will be recorded if measurable and likely, and disclosure of contingent liabilities will disclose the nature of the obligation, the estimation of amount, or to disclose that it can't be estimated, any disclosure of future events, and any additional loss that should be disclosed. In its note disclosure, provisions are not under ASPE, but contingent liabilities will accompany Note 25 and 31. Major changes include the lower value range, the change of asset retirement obligations using the option of straight line or effective interest method, and the exclusion of owner's contracts since ASPE has no guidelines for it. Since claims and lawsuits, indemnification obligations, and concentration of labor are not measurable, but are undeterminable or have likely probability, they will still be disclosed in its note disclosure.